Hey, everybody. We've got another episode of In the Money with Amber Kanwar on deck. We're just waiting for Jamie Murray. He's going to be joining us in studio of the Murray Wealth Group. I've made some money following him into certain stocks, and one of his specialties is identifying these underloved stocks, especially where the narrative has basically deemed them worthless. That's typically when he likes to go in. I followed him into a few names and made some money. Conversely, I haven't followed him into a few names and didn't make some money as a result. So he's got some great ideas. We talk about a bunch of those. And of course, as always, we get those pro picks. So let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. We all want to make the most of our investments. That's why BMO Investor Line is here. Their easy-to-use platform packed with tools, resources, and commission-free trading on over 100 popular ETFs can help you trade with confidence and take control of your financial future. Learn more at bmo.com/online investing. Jamie Murray, thank you so much for joining us in studio.
Thank you for having me.
So we've got markets at all-time highs in Canada and the U.S. Can we just fully ignore tariff risk because the headlines are so ugly and the market is just doing fine?
Yeah, let's just jump right into the tariffs. So that's what everyone's thinking about. The market, like you're right, the market's kind of overlooked it. I think there's Trump talks a big game, the art of the deal, ask for the moon and hope you get like a little piece of it. So there's definitely some of that being priced in, but having said that, I mean, we're definitely getting more concerned about the macro. We're seeing companies start to, on earnings conference calls, say like, we don't know what policy is going to be, and that's slowing down investment, or that's leading to suboptimal inventory because we're pushing inventory from Mexico into the United States ahead of a potential tariff deadline. So, we think these eventually will have some impact on corporate earnings, which then will affect the market. But on the positive side, we're starting to hear some like Trump supporters echo that sentiment, saying like, why are we starting trade wars, tariff wars? Echoing that exact message that this is going to start to impact investments, going to impact Americans' wealth. So we'll see how that goes, but it's still going to play out over the next few months, we think.
So how do you balance that in the portfolio? Are you reducing your positions overall, reducing exposure, or are you saying, yeah, that's kind of in the background, but I still want to be fully invested?
Yeah, so we're in our funds, we're always fully invested. We might look to reallocate to lower beta names if we're really worried about a pullback in the market, but generally we're long-term investors. We buy companies that are going to, we hope, survive a tariff war and continue thriving for the long term. So we're not readjusting just yet, but certainly we're looking at which sectors are going to be most impacted.
Looking at the characteristics of the rally so far this year, Europe has been a massive outperformer. Some of the most contrarian stocks out there are the best performing stocks, whether it's Palantir, whether it's Supermicro. Even in Canada, BlackBerry is the best performing stock in 2025 on the TSX. A lot of stories, with hair on them are outperforming. What does that tell you about the risk on mood?
It certainly is showing some sector rotation and some flows. Like we've seen some of the Mag 7 names underperform if we're just looking at year to date. And a lot of companies have been left for dead. And when you get a little bit of good news, you start to see that. And I think the European example is a great place to start, where Europe was, and nobody was looking at Europe. There are certain names that in Europe that were being, picked off by some fund managers, but in general, it wasn't where investors wanted to be. But European savings rates are astronomically high. And if we get some clarity on the war in Ukraine, we get inflation continuing to come down, I think we could see the European markets continue to rally.
Is that a place you would seriously look at gaining exposure? Because as long as I've been doing this, which maybe, I don't know if it's as long as you've been doing this, there has been a thought
maybe this is the year. This is the year for European outperformance.
For sure. And I mean, you'll get counter trend rallies in the 1 year where Europe outperforms US, and 10 years later, it's a blip on the chart. But I mean, we have seen the one thing in the North American markets that we're most concerned about is, on top of the tariffs and all that noise, is the valuations. You're not being compensated to the same level as, even 5-10 years ago to invest in the US. A lot of names trade at much higher multiples. And, we're running out of maybe catalysts to see those multiples continue to expand.
Where's your conviction right now then? Is it still in US stocks, or do you find better opportunities here at home?
I mean, I think we still have more conviction in our US holdings. We run a global portfolio, so we're looking all around the world for the best opportunities, and certain names in the technology sector we think are still very attractive. Certain consumer names that are growing their presence in the US are attractive as well. And, you still do get, hopefully, that stability that we've had for the last 40, 50 years, that the U.S. is, going to be a place that follows the rule of law. But, maybe we're starting to see some of that change.
Valuations, are you concerned at the levels that we're seeing in the markets?
Yeah, for sure. We've definitely sold some names that saw valuations sort of expand outside of their historical norms. We kind of look at a stock trading over 35 to 40 times PE as just getting too expensive. I mean, there's certain examples where a company is growing and scaling up and their margins are going to double or triple. I think Amazon's a good example of that, where the margins have gone from 5% to close to 10%, and we think longer term they can get up to 20 or 25%. So we're okay to pay a higher PE for those type of companies, but some of these names that are mature businesses that are taking market share, we've seen the multiples. I mean, in the grocery space, we've seen that with Costco, and that's a name that we have owned. It's a phenomenal company, but we don't need to pay 50 times for a 10% earnings grower.
So you got rid of it?
Yeah, we got rid of it. We got rid of it way too soon. Like, we would have doubled our money if we had held on to it. And, we certainly let some companies go too early, but, it all comes back to your investment process, and we're being in that sweet spot where historically we've had the best returns.
Okay, let's dip into the mailbag now. Okay, Jamie, our first question is about Aritzia. You've owned Aritzia since 2018 and stuck by it even during a big downturn. It's made a huge comeback over the past year. Do you still like it, and would you buy at these levels?
Yeah, so we still like Aritzia. It's still one of our larger holdings in our global fund. We sold a fair chunk of it in the last month following the last earnings report. We had some pretty good intel in December, November, that their Black Friday and current sales rates were going to be pretty strong, pretty healthy, and that's what they indicated on the conference call. But at the end of the day, it's still a consumer discretionary fashion retailer. We saw what happened in 2023. Expectations are much higher now. Comps going into next year are going to be very hard to lap. And so, there is some near-term risk that getting into 2026, you're going to see growth rates slow down and the multiple maybe not expand too much. But having said that, we still view this as a company with another decade plus runway of store growth in the United States, and profit can triple. So we're still long Aritzia.
So still long Aritzia. 2023, you're referring to a 60% drawdown in the stock during that year. You're selling-ish around an all-time high, but still maintaining a position. A mea culpa from me, because you talked about this the last time we spoke, and I said, I don't know. I did follow you successfully into another stock, and we're going to talk about it, but I didn't follow you into Aritzia because, I was like, I don't know, I didn't find their assortment was all that appealing, and a 20-year-old told me it wasn't cool anymore. So that was my market research. It sounds like yours was a lot better.
No, and I mean, I think that was a common bear case, was that it was losing some share amongst its consumers, but they talked about that too. They said our fashion inventory isn't where we want it to be. We have new styles coming out, and those are really resonating. I mean, it's a company with a 40-year history now of continuing to grow and expand. And, it's getting back to what I said. It's not always going to be the right assortment. There's going to be other times to to pick up the stock for a nice price, I'm sure. And so we're expecting to see more of those along the way. But over the longer term, we think this is going to be a much larger company.
You are trimming your position, though. And the question is, would you add here? Because when you talk about multiples, it's trading at 37 times forward earnings. Are we really paying that for a retailer where that sort of sector can be fickle?
Yeah, exactly. It's gone from extremely cheap to more of a premium name again in the sector. Having said that, they're comping 20% same store sales growth, which is just astronomical. And this follows the huge growth they had in 2020 and 2021. So, I think it is establishing itself as a best-in-class retailer. Would you add to a position? We generally trim when stocks go up, and we like to buy when others are selling. So we're not one to double down on a company, especially when it's doing what we thought it was. So we're just, now the multiple's doubled.
So you'd wait for a pullback. Our second question is, what is your favorite Magnificent Seven name?
Yeah, that's a good question. So our favorite Magnificent Seven name, Alphabet, is our largest holding in our global fund. And so I think I'll say that one just by default. I mean, it has the lowest PE ratio. It has the most hair on it as well in terms of the antitrust investigation and the search business moat that is still holding in, but every day there's a new Gen AI product that investors worry might chip away at that. But we think that it doesn't give a lot of credence to Google's own innovations. Like Waymo has come up out of, I don't want to say nowhere, 2018. There's a lot of headlines around it, but then it got really quiet for 3 or 4 years, and now it's established itself as a leading autonomous vehicle platform. We think there are some interesting assets in Google Cloud and in their AI division as well that, they need to execute on the product development, but the technology assets are there. And then search, we think AI is the way we see it morphing over the next 3 or 4 years. Is it's really going to come back to having that walled garden of data where only you have access to that data. Now, the antitrust investigation could force them to sell some of that, but they still have probably the largest collection of consumer data in the world, we think. And they have it structured in a way that they can use it to build applications. So whatever direction Gen AI ultimately goes, we think Google will be a major player in that.
So Google has lagged so far this year. The Mag 7, if you don't know, you're not a big investor. It's 7 stocks: Apple, Nvidia, Microsoft, Amazon, Alphabet. Did I say Apple already? Meta and Tesla. So those are the Mag 7. Google is down about 2.5% so far in 2025. The Mag 7 has actually lagged the broader market so far in 2025. What do you think is driving that? Would you use this as an opportunity to add?
So it's had 2 years of massive outperformance. I think most of the returns, I don't have the numbers on the top of my head, but most of the return in the last 2 years has been these 7 companies, 8 companies if you include Netflix and some other large names. It's very concentrated. Exactly, Broadcom. So very concentrated market that we've seen. And so we're seeing this broadening out. We talked about valuations on some of these names being a little bit more elevated. But we think we're still sticking with, we own 4 of these names. So we own Alphabet, we own Meta, it's our second largest holding. Microsoft and Amazon are all in our top 10. So these are the 4 names that we're very comfortable with the valuation. We're comfortable with the long-term growth, and market flows aside, these are names that we would look to add to in this market.
Okay, so that's interesting because while the Magnificent Seven hasn't rallied very strongly, and as a group, they're flat in 2025, this next stock that we have a question on, Uber, is one of the best performers already in 2025. The question is, Bill Ackman recently said that he thinks Uber is trading at a massive discount. What do you think? Do you like the stock?
Yeah, we agree with Bill in this case. So we actually wrote up a similar report, I think, to what Bill put out. Maybe not as many slides, but a similar note in August outlining why we like Uber. And it's really this massive cash flow inflection that we're seeing. They're dominating the ride-sharing market. International profitability is improving. Their delivery business is, we think, as good as Grubhub's. And if you put a Grubhub multiple on that, you get a very cheap value for their mobility business. But it kind of comes back to what we just talked about, the autonomous vehicle market and how this develops. If it's just Waymo as the only provider, Waymo's going to have a very nice, be in a very nice position, but we don't think Waymo alone is going to be a large enough competitor to impact the ride-sharing market on a global basis. It's going to take them too much time to build out this fleet.
Okay, but the stock has already rallied more than 30% so far this year, trading at around $80. Do you see more upside from here?
I think we do. It kind of goes back to that how the AV autonomous vehicle market develops. If it's just Waymo, there's going to be enough rideshare demand that Waymo is not going to be anywhere close to satisfying all that demand. You're still going to have a massive need for Uber. Adoption rates, even in Canada, North America, still are increasing. And it's really the only place to get a rideshare right now. And so we think there's still a good future.
Are robo-taxis disruptive to Uber or the next leg of growth?
So robo-taxis are disruptive if they're not on Uber's platform. And so if they're on Uber's platform, that's great for Uber. It'll bring down the total cost. You can eliminate, unfortunately, the human drivers in that operation. But where it becomes a problem for Uber is if it's just Waymo and probably Tesla who have this technology, then Uber could be a distant third in the robo-taxi market, and you start to see that moat get chipped away.
All right, let's take a quick break and we'll dip back into the mailbag. And we're back with Jamie Murray of the Murray Wealth Group, and we're taking your questions. Our first question in the mailbag here is Northwest Healthcare Properties REIT. What happened to this one? It's a healthcare REIT. It is down massively from 2021, 2022. It's rallied a little bit in the last couple of months, but maybe a backstory before we talk about whether you should buy here.
Sure. So Northwest Healthcare Properties, it owns healthcare assets, hospitals, medical office buildings, and the like. They have operations around the world. So Europe, North America, Australia is a big market for them. And what happened in 2021 is the previous management team just got way too aggressive buying properties with floating rate debt. And just like the condo investor in Toronto who bought a property back in 2021 with 1% interest rates, when that turns into a 4, 5, 6% rate, you have a bit of a cash flow problem. And so they were forced to cut the dividend under the new management team that came in. But it really just was a matter of getting over-levered and overexposed to a big move in interest rates.
That's a classic tale. That's what happens with these roll-ups. They cut their dividend, but still they have a 7% dividend yield. And they've started to perk up, as I mentioned, so far this year. Are you interested in this turnaround effort, and is the dividend sustainable?
Yeah, this is a stock we've been adding to fairly aggressively in the last, I'll say, year. We've met the new CEO a few times. He was running their Australia business before being promoted to this role, and he's really changed the whole philosophy of the company. He wants to increase the quality of the REIT, so better financial profile, more consistent earnings, less of a speculative investments on their balance sheet. And we just think the market's not really giving them any credit for the progress they've made. So over the last 18 months, they cut the dividend, which a negative at the time, but now that's readjusted and reset. They've sold off a ton of assets to bring their leverage down to a reasonable range. And most impressively, we think they've just improved the financial culture around the organization. And that's just recently, this week actually culminated in them getting an investment grade rating from a bond rating service.
And is all of this turnaround enough to overshadow whatever happens with rates? I mean, I guess rate cuts are helpful when you're a yield stock, but can the story work if there's a stall in the rate cut environment?
We think so, because they had so many loans that were almost somewhat distressed. They have a convertible bond that they were paying 10% interest on. Now that they're investment grade, they just raised $500 million at 5%. So they've cleaned up the balance sheet. They're going to see their interest expense come down over the next couple of years as they refinance their debt from a better position. Now, obviously, if interest rates increase a whole bunch from here, that's not really going to be good for any real estate assets. But Northwest, they do have inflation protection in a lot of their leases. So you should get the leases increasing at a similar level. And it's important to know these are very high quality tenants. They're selling office space to doctors' offices and hospitals. So very stable tenant base.
Our next question is on Air Canada. This one came through X Yield Chaser 88 wants to know, can I get your updated thoughts on Air Canada? And this one, Jamie, I followed you into, and I sold at a perfect time, and I was up 70%, and I sold right before earnings, which is when the story started to come undone, and it's really been just a one-way ticket south since then. So thank you for that return. The question is, did you hold on? Did you sell as well?
I wish you called me and told me to sell, because we're still holding it. We did trim some in the 20s. Again, just for our sort of policy and how we manage money, we'll trim our winners when they get overweight. So we did sell some, but we still think there is a long-term story here. The numbers that came out last week, their financial results were very strong, we think. It's just this stock has become such a narrative stock where the market's always just expecting guidance revisions. First it was the Canadian domestic market. Now it's Canadians flying down south, tariff risk. So there's just so much noise around this stock, but we think it's in a better position to manage this now with implementing a share buyback program, financing their expansion through debt that they have available. So we think it's going to be a much cleaner story going forward.
Why has Air Canada lagged so massively some of the big companies in the U.S. and not re-rated at all back to where it was before the pandemic?
I mean, I would love to know that too. That's our thesis. Air Canada, their whole expansion plan involves buying very highly efficient planes to fly people from Asia and Europe to the US and vice versa. So they're benefiting from this global air traffic demand that we're seeing, and very strong results across the board. It just goes back to those negative headlines that are Canadian specific, and I think it's just getting put in this box where Canadian economic problems are Air Canada's problems. And there's some truth to that, but we're still seeing a very healthy demand environment.
So what do you think the catalyst is for that to turn around? Because people who love the stock, and it's pretty universally loved on the sell side as well, they say it's so cheap, such a discount. As you mentioned, the results show that there's execution, and the worst case scenario hasn't shown up. And even if it has, you could ask, is it already priced in? Having said all that, it doesn't matter for the stock. As you say, it's a narrative stock. There has to be a catalyst, right, for this to work?
Yeah, and I think that's going to be the narrative change, and we're hoping that is better economic conditions in Canada, whatever it is that brings that on, whether it's stronger commodity markets, maybe a government change. I think if it's Canada can get back to being the Canada of old, where it's viewed as this very strong banking, finance, capital of the world, then I think that'll do wonders, not just for Canada, but a whole bunch of Canadian industrial companies.
Would you add here, or would you wait for it to settle down?
Yeah, we've definitely been adding under the $18 level. So no problems adding here, and we're expecting it. I guess we think this is going to be over 30 at some point. I keep saying next year, but one of these years we think you're going to get a big move in this stock.
Let's see. It hasn't been above 30 since the pandemic, so that would be a big breakout. And hey, I was wrong about Aritzia. I know ultimately your patience paid off there.
Yeah, I mean, it goes back to when companies are in this sort of these doldrums where nothing seems to be moving the stock. It's cheap. That's when we want to see those share buybacks start to accelerate. And so Air Canada just bought back 10% of the company. We think if the price stays at this level, they'll renew that and buy back another 10% next year.
Okay, let's check in on our next question. This one is about C&Q. It's underperformed recently and the stock is cheap. Would you be a buyer here? This one coming from Young Guns, one of the fans of the show on Instagram.
Yeah, so C&Q is one of our favorite holdings in the energy space. We own about a 3% weight in our income fund portfolio for this name. This is one that we added in 2021. Split adjusted, it was around $30. So we've done pretty well on this. I think it's just a case where the stock did get very expensive relative to other Canadian peers in 2022, 2023. We trimmed about half our position in that time. And we've recently been starting to add back to it because we think the Canadian energy companies have been unfairly punished based on this tariff rhetoric. We don't think tariffs on Canadian energy make any sense whatsoever for the United States. And we've seen that start to shift in the last, call it 2 weeks, where now the focus is less on Canada broadly and more specific, and energy has been excluded from that narrative.
So would you, why has CNQ lagged? Because everybody says they haven't had really an operational hiccup. The balance sheet is good. They do well with oil above $70. Is that right?
For sure, yeah.
So why has it lagged?
I mean, I think it's just digesting a big move that it made from coming out of the pandemic and returning 300-400%, and definitely you saw a lot of new investors rush in. Expectations are higher, but now it's back to a place. The multiple has come down. The oil price is still strong. It's back to a place where you can probably get 10-15% a year out of it.
Okay, so you like it. Let's transition to the pipeline stocks. Can I get your view on Canadian pipeline stocks? I'm a holder of Pembina, Enbridge, and Keyera. It seems that these stocks are declining. Wondering if I should be concerned or if I should keep holding for the dividends.
Yeah, so we think this is a really attractive space. So we own, in the space, we own Enbridge, we own Pembina, we also own Gibson Energy. So a nice play on volume growth. We think volumes will continue to push higher in Western Canada. Ultimately, that's what drives new projects from being sanctioned and more demand for their services. And again, it comes back to, we're going to get a new political leader in this country regardless in the next 6 months to a year, most likely. And it sounds like they're going to be more pro-energy, more pro-industry than what we've seen. And so I think
that's true even if Mark Carney is the Liberal leader and Prime Minister?
So I know there's a lot of, I've heard the clips. Without getting into my personal political views, I think Mark Carney will be more business friendly than the Trudeau government has been.
And that will apply to the energy sector.
That will apply to the energy sector. I mean, Brookfield's a big player in this sector. Mark Carney's very heavily involved, or was heavily involved with Brookfield. And so I think ultimately he understands that Canada needs to get the economy moving. And but yeah, we'll see what happens.
These stocks did sell off, as particularly Enbridge and TransCanada. And I saw some analyst notes saying that some of the disappointment was maybe around AI exposure, that the pipelines didn't say enough about, I guess, how much demand was going to increase about AI. Is that ridiculous, or is there sort of some validity to that?
I think it's a little ridiculous. We saw another holding that's not a pipeline company, but Capital Power is one that we own, and it's been a typically stable power generator company moving up and down 15-20% on AI headlines. And I mean, regardless of how the AI market and data center market plays out over the next 3-4 years, we still think there is a massive need and demand for new power and new energy infrastructure. And so these companies are going to have products that get built. It's just, it's a matter of if, not when.
So you said you own Capital Power. Our next question is about Northland Power. What does Jamie think about Northland, and is it a long-term hold in my RRSP? Is the dividend safe? This one coming from Tristan.
Yeah, so a couple of different questions there. Northland Power is a name that we've recently added to our income portfolio. We like that 6% dividend yield. That's one of the reasons why we added it to the portfolio. We really like the new CEO that they've brought in. They just did a year-long CEO search and hired an executive who actually sits on Canadian Natural Resources board and worked at Atkins Realis in running, and has very good experience in many different energy applications. But one of the whispers we're hearing is that dividend might be cut, not because they can't afford it, but because they're looking at accelerating growth. They want to generate and fund that internally. And so is the dividend safe? It could be. They have no problem paying this dividend for the next 10 years. We think they could easily afford to do that, but they might choose to cut it and reaccelerate growth. And so there might be some volatility until we get clarity on that.
And what would you do if they did cut it? Would you still hold it?
We would still hold it. We bought it. We like the 6% dividend, but we bought it on, we think there's $25 to $28 of asset value in the company. And so trading below 20, we think one way or another, you're going to get that value realization. And this management change, we think, was going to be the catalyst for that. Now, if a dividend cut is part of what helps it move up to that level, ultimately, we'll hold through that.
Our final question in the mailbag is about what's going to happen next week. We've got Canadian banks starting to report their earnings. Canadians love their bank stocks. What's your favorite name in the banking sector? This one coming from Hugo.
Yeah, so our favorite name in the banking sector is Toronto Dominion TD. We were pretty aggressive buying it in both of our funds this past summer. We didn't own it in our global fund until I think July. We sold out of our BMO shares and bought TD. It actually turned out not to be the right trade because TD, the news got worse than expected. But we've just been using the sell-off to add. We think there's $110 of value in TD today. So
TD, a bit of a turnaround play, but also it's TD and BMO that are the best performing Canadian bank stocks out of the big five. And that's being chalked up to the fact that it does have that U.S. exposure. Is that part of your tilt? Like, do you want to look at these Canadian banks that have more U.S. exposure given what's going on in the Canadian domestic economy? And how do you expect the Canadian banks to communicate about tariffs? Are they going to bring their provisions up? Like, how do you think about that?
Yeah, that's a good question. So TD and Bank of Nova Scotia are our two largest holdings in the banking space. They have international exposure, so we definitely like that about both of them. TD obviously is a little limited in growing that U.S. business right now. So if that was just a thesis, it wouldn't be the way we would play it. As far as what to expect, I mean, we're not expecting any material information on the conference calls next week about tariff exposure because we haven't really seen anything implemented. And I don't think the banks are going to have any data showing that there has been some sort of material effect to their finances or what they're seeing.
But that uncertainty, maybe you don't take out that loan to fund expansion.
Yeah, I still think it's going to be a little bit too early for them to say that. I mean, ultimately, loan losses are what's going to really drive the next leg of the bank. And so it's really going to come down to how the Canadian economy performs.
It's interesting you mentioned Scotia because this week an analyst downgraded Scotia because of its tariff risk exposure due to its operations in Canada, but also Mexico.
Yeah, and so we saw that Bank of Nova Scotia was getting a little momentum last year when it was looking like the bank that was best positioned from a financial standpoint for lower rates, probably a stronger Canadian economy. And so that it is affected by that. We haven't seen rates come down maybe as quickly as some thought, particularly in the United States and the longer term rates as well. So, but ultimately we know the CEO from his days at Finning. We think he has the right strategy. He's going to turn the ship around, and we think he's been doing it so far. And so we still think there's going to be more upside in this name. And, like I said at the outset, ultimately we're owning these companies beyond a tariff war that hopefully will be short-lived if it happens. So yeah, we'll look through that.
All right, let's get into Jamie Murray's Pro Picks. This segment is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Okay, Jamie, let's get into it. Your top picks. This is super interesting. You've got a lot of names here, 3 of them. The first one is Broadcom, and people say the Magnificent Seven should expand to include Broadcom because the rally has been so stunning in the name. It's a $1 trillion titan now in terms of market value. Why do you like it here? Why would you add?
Yeah, so the reason why you own Broadcom is we think it's the best manager of technology assets in the world. Now that's a bold claim, but I think if you look what the CEO Hock Tan has done with the company over the last decade or 15 years, he's really turned it into this $1 trillion titan from starting with just a small little few product semiconductor company. So to get to this point, I think a lot of it's just owed to that management culture, and it really is a very ruthless finder of efficiencies, and so that it's grown through acquisition. What their playbook is on every acquisition is they come in, they cut out almost all the sales force, they bring that over to in-house. they change the go-to-market strategy. They'll increase pricing on products. They'll cut products that don't make sense. But then they'll also reinvest in research and development. And so they'll actually usually be able to accelerate the growth rate of these acquired companies and, do it in a much more profitable way.
So how would you compare it to an NVIDIA? What's its wheelhouse versus an NVIDIA, and what kind of upside do you see?
Yeah, and so on the AI side, Broadcom's the second largest provider of AI technology products after NVIDIA. Like I said, this is a much more diversified company. It has enterprise software as well. But why the name's in the headline now is this AI business that they have. And, the difference between NVIDIA and Broadcom in terms of how they operate, and I'll keep this very general, is NVIDIA makes the LeBron James of chips. It can do anything, it can do everything, it can dunk, it can shoot a three-pointer. Broadcoms are much more specialized. So it might be the 7'5" center that you need, and you can get this, or you might be the 3-point shooting point guard that you want. So they make very specialized products that aren't as dynamic as NVIDIA's, but are much more efficient at one thing. And so we're seeing companies like Meta and Google, who are their largest customers, buy tens of billions of dollars of these chips from Broadcom rather than NVIDIA, because they're saying, we just need this chip to run our video recommendation algorithm. And we don't need to pay NVIDIA's prices to do that. We can get a much more effective chip from Broadcom for this. And so we think over time, we're going to see more companies making these specialty design chips. And Broadcom, we think, is going to be the biggest benefactor of that.
What kind of upside?
So that's a good question. I mean, the multiple has really expanded in the last 2-3 years. A lot of that is on this AI side, but they're also guiding to huge growth in this AI business over the next 2 or 3 years. So, this is a name that I think our target price is maybe 25% above where it is today, but they find ways to create value. And in the news now is they're maybe looking at buying NVIDIA or Intel's.
Yes. Would you like that? Would you like that?
For sure. We would love that. Some of the early numbers we've seen is Broadcom could pay a huge premium. And even if they get anywhere near the efficiencies they typically get, they should be able to make it earn 25% returns on that. So we just want Broadcom to, like I said, we think technology assets are best used in Broadcom's hands, and so the more assets they can acquire, I think ultimately that's going to be what drives the price higher.
That's interesting, especially with those Intel headlines. So something to keep an eye on. Your second pick is Starbucks, and it's going through a bit of a transformation under a new CEO who's got to bring Starbucks back to Starbucks, I guess. It's worked in the stock. It's up quite a bit from the lows in 2024. How do you think about the turnaround, and would why is now a good time to buy it?
Well, that's exactly what they're doing. Back to Starbucks is the name of the turnaround plan that the new CEO, Brian Nichols, put in place. Again, going back to management teams that can create value, Brian Nichols has done this first at Taco Bell and then at Chipotle Mexican Grill. Chipotle Mexican Grill, the stock was up, 1,000% over his tenure. Profits increased 600%. So just putting, again, Starbucks is probably better in the hands of Brian Nichols than the previous management team, who really wasn't too inspiring. And they're already finding ways to improve the operations. We're seeing some early success, some small wins. A couple of notable ones is they're reducing the size of the menu. They're putting in digital menu boards so that they can have a more dynamic menu to better serve customers at different parts of the day. So they probably sell more Americanos at 7 a.m. than they do at 7 p.m. So digital menu boards, like little easy things like that. Another thing is they've found a better algorithm for mobile orders to sequence them better so that the baristas at their locations have an easier time serving up when they're overwhelmed. It's a better timed production schedule. And so these are just very small things that can have a huge impact. And ultimately, at the end of the day, Starbucks has 10,000, 15,000 of these boxes, their stores across the US. And if they can find a way to make each of those boxes 10, 15, 20% more productive, then that can really drive a lot of value.
So there's a lot of optionality in terms of things that they could adjust from an operations perspective. The stock is up 55% from the lows in 2024. Has the market already caught up to that, or do you think that there's more upside there?
I mean, certainly the market's priced in some amount of improvement. The stock was up 20% the day it was announced CEO, but it's trading at the same level it was, I think, 2 or 3 years ago. Now, earnings and sales have been weak the last couple of years, so the financial profile isn't quite as strong today as it was 2 years ago. But, I think some quick math, I think Starbucks can earn $7 to $8 in earnings per share, and we're going out a few years, like 2028, 2029. And if you put a 25 times PE multiple on that, that gets you to $175 to $200 stock in, call it, 3 to 4 years.
And so, right. Well, I just want to quickly pull up the chart. Right now, we're trading at around 110, call it.
Yeah. So it's, there's 50 to 60% over 3 to 4 years. Probably 15% is what I'd expect out of Starbucks compounded.
Okay, your third pick, not a household name. It's 3I Group, infrastructure, private equity, and trades in London, and trades at an all-time high. So, you like to trim stocks at all-time highs. You've just told us that. Why are you adding to this one?
Yeah, so 3I, you're right. It's it's not a household name, and it's a very unique organization how it's run. I mean, I think it's now in the top 20 companies in London in terms of market cap. So it is a large company. It's a private equity company, but 75 to 80% of the value of the company is in this one investment they have in another company called Action. Now, Action is, for Canadians, I'd say it's the Dollarama of Europe. The CEO says, we're not like Dollarama, we sell way more stuff. And they do sell products that are 30 or 40 euros, unlike Dollarama. So more of a mix between a general merchandiser and a discount retailer. But at the end of the day, the products they sell on a SKU basis sell for about 30 to 40% cheaper than other nearby competitors, even in the discount space. And so they've taken huge market share. Action started in the Netherlands. They've taken over France. There's 700 locations in France just in the last decade. They're moving into Italy, Spain. They're looking at Portugal. They're big in Germany, moving to the Czech Republic, Poland. So it's really just this huge growth retail platform. And they see many more locations for these Action stores. They have about 6,000 locations across Europe today. We think they can get to 10,000 just in Europe, and they're looking at other markets like Southeast Asia and even the US for expansion.
So this is really a play on a European Dollarama.
Yeah, that's the easiest way to break it up. It is an investment private equity company.
Yeah, I'm trying to look at like what they say, 90% of the revenues come from, infrastructure and operational projects, but it's really, you said 75%?
75% of the value is from this Action. Now they do have,
okay.
They have some other holdings in European retail companies, like there's a bakery that sells baked goods across Europe. But I mean, most of the values and I think other investors own it for this Action investment.
And you think it can continue?
Yeah, we think it can continue. The stock, like Action's growing probably 20 to 25% on a top line basis over the last decade. And we think they can grow at a 20 to 25% top line number, probably closer to 20% for the next decade as well. So, it's one of those stocks where put it away, we think it'll do well in low inflation, high inflation, because it all comes back to just getting scale economies. The more they buy, the lower prices they can offer. They actually lowered their prices in 2024 because they said, we're making too much money now. We're going to bring prices down to bring more and more consumers in. And it's just, it's a phenomenally run retailer, and 3i is the only way you can play it.
All right. Thank you very much, Jamie Murray, for these ideas and for joining us for this great conversation.
Yeah, thank you so much for having me.
That's Jamie Murray of the Murray Wealth Group. Make sure you join us on the next episode. We've got Justice Parmar joining us of Fortuna Investments. He's got a really interesting focus. He loves to focus on those moonshots. Sometimes, quite literally, he focuses on space stocks as well as other growth areas of the market. You can get your questions in at questions@inthemoneypod.com. Find us anywhere on social media at In the Money Pod. And of course, you can check out our website and submit your questions through there, www.inthemoneypod.com. And we'll see you on the next episode.